93% of investors who bought AI stocks in the last 18 months bought the wrong ones. They chased the wave after it already crested. And right now, while they're watching Nvidia consolidate and wondering what went wrong, three new waves are forming that could dwarf the initial AI rally. Today, I'm showing you exactly where the smart money is rotating, backed by data, not hype. Here's what I promise you: by the end of this video, you'll know the three specific sectors institutional investors are quietly accumulating. You'll understand why the obvious AI plays are no longer the best AI plays, and you'll have a framework for catching the next wave before CNBC starts talking about it. Let's get tactical. First, you need to understand why the original AI trade is effectively dead. Not dying, dead. Nvidia ran over 900% from its 2022 lows. Microsoft, Google, Meta all priced in at least 5 years of AI optimism. The easy money was made by people who bought before ChatGPT became a household name. If you bought after November 2022, statistically, you've underperformed the S&P 500 on a risk-adjusted basis. That's not opinion, that's math. But here's what most people miss. Every major technological revolution follows the same pattern. The initial winners are the obvious ones, the companies building the core technology. Then pause. The real wealth creation shifts to the companies that support that technology and the companies that deploy it profitably. Think about it. During the internet boom, Cisco made the infrastructure. They exploded first. But Amazon, Google, and Facebook, companies that use the internet, created generational wealth in the decade after the initial bubble. We're at that exact inflection point with AI right now. So where's the next wave? Wave 2 is the power problem, and this is the one nobody's talking about. A single ChatGPT query uses 10 times more electricity than a Google search. 10 times. Goldman Sachs estimates AI will drive a 160% increase in data center power demand by 2030. That's not a typo. 160%. Right now, there literally isn't enough electricity to power the AI future everyone's betting on. That's a problem, but for certain investors, it's an opportunity. Utility companies with nuclear exposure, independent power producers, and companies building next-generation grid infrastructure are seeing institutional accumulation that the mainstream hasn't caught on to yet. When Microsoft signs a 20-year deal to restart 3 Mile Island, yes, that 3 Mile Island for AI data centers, that's not a headline, that's a signal. Wave 3 is the infrastructure build-out, and I'm not talking about chips anymore. I'm talking about the physical layer, cooling systems, because these AI servers run so hot that traditional air conditioning doesn't cut it. Networking equipment, because moving AI workloads requires bandwidth we haven't built yet. And real estate, specifically data center REITs, that are seeing demand they literally cannot fulfill. Here's a number that should wake you up. Data center vacancy rates in primary US markets are below 3%. Below 3%. In Northern Virginia, the world's largest data center market, it's under 1%. You can't build fast enough to meet demand. Companies with existing capacity and expansion capabilities are sitting on gold mines, trading at valuations that don't yet reflect this reality. Now, Wave 4, and this is where patient investors could see the biggest payoff, is enterprise AI software. This is the deployment layer. The companies helping businesses actually use AI to cut costs and drive revenue. See, there's a massive gap right now between AI capability and AI implementation. Executives know they need AI. 72% of CEOs in a recent McKinsey survey said AI is a top 3 priority, but most companies have no idea how to actually deploy it. The businesses that bridge that gap, that take AI from a demo to a deployed solution generating ROI, those are the next Salesforces, the next Adobes. We're talking about companies in vertical AI software, AI security and governance, and AI operations management. These aren't household names yet, most of them are still private, but the ones that are public are showing revenue acceleration that reminds me of cloud software in 2016. So how do you actually position for this? 3 principles. First, follow the capital expenditure. When Microsoft, Google, and Amazon announce billions in AI infrastructure spending, trace where that money flows. Those are your Wave 2 and Wave 3 candidates. Second, watch the acquisitions. When enterprise software companies start getting bought at premium valuations for their AI capabilities, the remaining independent players often get repriced. Third, and this is crucial, pause, be early but not too early. The difference between visionary and dead is about 18 months. Look for companies with revenue, not just roadmaps. Customers, not just conferences. The next AI wave won't be televised until it's already obvious. By then, the biggest gains are gone. The question isn't whether these sectors will win. The infrastructure has to be built, the power has to flow, the software has to be deployed. The question is whether you'll be positioned before the crowd figures it out. If this analysis helped you see the market differently, subscribe and hit that notification bell. I release research like this every week, the kind of data-driven insights that help you invest ahead of the headline cycle. I'll see you in the next one.